I have three separate accounts and I keep them separately on a very specific purpose. And I've noticed that most professional traders, they also have three separate accounts, sometimes only two, which is something that I'm also getting towards. The three different kind of accounts you should have are very simply categorized into certain category that are easy to understand. However, on the inside of it, there could be a lot of involvement. But if you had to break it down in a simple format, there should be your long-term account. Your long-term account is not the account you trade long-term stocks in. It's the account that you buy strictly in only one item, and that is the index. There's three indices. There's the Nasdaq, and there's the Dow Jones and the S&P. They're all virtually identical in terms of price movements, but you have the Nasdaq, which has more technology companies, and then you have the Dow Jones, which only has 30 companies. Some people argue that that is not very indicative of the overall industries. And then you got the most popular and most active one. It's the S&P 500. All these have ETFs that are traded. How to access them? The ETF is basically what you buy to access the index. For the Nasdaq, it's QQQ. For the Dow Jones, it's DIA, and for the S&P 500, it's the SPY. These are the main ones that have the most liquidity, most volume, most options, the least spreads in terms of bid and ask. There's a lot more ETFs that reflect the indices, but these are the main ones. I personally use the SPY just because it's the easiest to access in terms of volume, and it's also the mostly tracked index. This account that is, again, titled, this first account that is titled long term, again, it should be just buying the index. It should not be individual stocks. It should not be any other items. It should be just the index. Think of it like a 401k where you can only select funds. This one is almost the same. And if you can do it through a retirement account like an IRA or a 401k, this should be the first thing you should do. The advantage of having it through a brokerage account, if you're able to do it through an IRA, they usually give you more flexibility. For example, you can trade options on it. Now, trading options on a long-term account, unlike most people think, is not so much to buy and sell daily or to time the market. No. The way I do it is I'm constantly bullish. However, instead of holding the shares flat out, I usually do it through options. Typically vertical options, so that I'm not paying anything for time decay, and so that I have a limited risk. And also, it puts a limited gain when you do a vertical option, for those who understand what a vertical option is. However, for something like the index, they usually move very slow. So the whole concept of a limited gain is not really a big issue that comes in the way. Options on the index or on your long-term account should be obviously long-term options, the very minimum. The minimum should be 90 days option, and it should be simply done to enhance the returns and lower the risk. It should not be necessarily here to over leverage or to buy out of the money calls or to try to make a killing. Buy and hold as a strategy has worked for the last 100 years. There is no need to fix something that's broken. What we're simply doing here is doing buy and hold on steroids, or adding a little bit of salt and pepper on the strategy that already works. This obviously is something you would want to do only once you understand options. But that does not mean you don't start with an account that has that. In the very beginning, before you even trade, before you do anything, you should always have a long-term account that you constantly are bullish, and you just simply buy the index. Whether you do it through options when you know how to do so, or you do it directly through the shares. Think of it like the gym. You go to the gym for the first time or second or even 10th time, you won't know all the exercises. And even if you do, you're not necessarily going to do better than the simple exercise of walking. Think of investing in the S&P 500 simply like walking. It works. It's simple. It gets you where you need. Until you learn stuff that's significantly better, you should constantly and almost always, even big professional traders, always have long-term accounts, not only because it's simple, but it's also stressless and it does not consume time. You simply dollar cost average into it and you buy every 2 weeks or every month or whenever you do your contributions. Ideally, monthly is usually a good timing or a good frequency to do a contribution to it. If not, 2 weeks would be even better. The idea is you contribute on consistent basis. If it's going up, you're making money. If it's going down, you're buying at a low price. Something like the S&P 500 always goes up in the long run. The worst case scenario is you simply hold on to the shares that you have or roll the options in a situation if you're doing options trading. Again, think of investing into it as walking. It's a simple exercise. It works. It's stressless. Most importantly, it does not consume time. Keep this note in mind, does not consume time as we move over to the other kind of accounts. The second kind of account, before we actually move on the second account, on the first account, people constantly ask how much do I contribute? And there is a very predominant notion that people are not doing it because they think the market is overpriced. And this is relatively always thought by those who have never invested or invested very little or have very little money. And very little is defined by their monthly income or yearly income in this situation. A large trading account or retirement account, if you call it, an account that goes in the long term, is considered to be 3 years your annual income. If you make $50,000 a year and your account is less than 150, which is a total of 3 years annual income, then really your account is not too large. So really, you would want to contribute to an account and buy, and you actually should wanting and hoping the index drops, because the amount of money you have in that account is not large compared to your income, and you can quickly average it down and buy on a discount or get a deal, sort of to speak. Remember, you're buying the index here. You're averaging down on something that is similar to buying a house. In the long run, it always recovers. You're buying value. You're not buying some no-name stock or even a big name stock could go bankrupt. You got stocks like BlackBerry, you got stocks like Sears Roebuck, Circuit City. These are all out of the game, including Blockbuster. Those are all bankrupt. And even if you buy big names like Microsoft, from 2001, 2002 throughout 2015, 16, the stock almost did not move at all. So again, you're buying strictly the index. The smaller your account, the more you want to buy, the more you want to try to bring it up to a larger size in relation to your income. Your income plays a very big role of how big your account should be or how much of a contribution you should do. If you have no account and you earn, let's say, $50,000 a year, if you can, put in $1,000 a month. If you can't, it's okay, even if you start small. But the idea is, don't move out of the market simply because you have this notion or idea or thought that the market is too expensive. The S&P all-time high is not the same as an all-time high in stocks. There's a different audio on that. You can listen and know why. The S&P always goes up in the long run. So the concept is, if your account is small, you should buy as much as you can and buy all of it, in the sense of that if it drops, you're now looking at a better opportunity than you have seen before. The second account, which is what's called the medium term, this is not much of a difference from the first one. This one is also kind of long-term, strictly bullish, the same as the long-term account. However, this one is for those people who think or believe they can pick individual stocks better than the index can do. And that may be the case, but just understand, the long-term account should always be the biggest. You should not have one account that you just buy individual stocks and say, oh, I'm doing it long-term. Long-term should always be, in my opinion, the S&P. SPY is the ETF for that. A medium-term account, in my opinion, should be an account that you only have if you, let's say, already have $100,000, for example, in the SPY, and you have another $30,000, $40,000 that you think you can buy individual stocks and get a better return on your investment. However, even with such an amount, even with such a size account, the time has to be weighted out against your income. If you are buying an individual stock even if you got into, let's say, Wells Fargo at $20 or $30 or 25, which is considered a big discount from where it used to be at the high 66 at one point, or somewhere in the 60s, then you basically are going to be mentally occupied. You're going to be reading about this stock. You're going to be reading articles. You're going to be going to all these websites. And the time and energy it takes just to read up on this stock, if you're looking to make an amount that does not exceed your yearly income, then you're pretty much wasting your time. There's another audio I have, which is on the why trading individual stocks is a waste of time. Because even if you got the stock correctly, that does not mean just by making money that you succeeded. You could have made money, but guess what? The index have outdone it. Almost 2/3 of all money managers, and we're talking professional money managers who do this for a living and that have millions, if not billions of dollars of funds, they usually do not beat the index. So what makes you think you're going to beat it? And matter of fact, if you do beat it on your end, if the amount of money is so small, then again, you're wasting your time in comparison. Yeah, you might have beat the index, but you're actually wasting your time in the sense of you did not make more money than the job or the whatever you do for a living that you already do, because you've put in more time trying to pick this stock than you did, let's say, in the amount of time or money you would have made just working your regular job. So this second account, the medium term, is also always bullish, but you would basically typically want to buy big names. When I used to do it, which I'm phasing it out, I used to buy big names that have gone on a discount. I've bought, for example, Wells Fargo at 25 in 2020 when it went down all the way from the 50s and the 60s. That was a good trade. I've bought Staples before. I can't recall the price. I've bought GE at $17 in 2017 or 18, which I thought was a great deal. And guess what? The stock went all the way down to 550. It eventually recovered to the 11, 12, as of this writing, 11, $12 range. But guess what? The amount of time and the money it tied up, it was not worth it. This is one of the biggest reasons why I stopped. And again, even if you get the biggest names, they could still bankrupt. We've mentioned earlier names that have gone bankrupt and gone under. And even if you get a big name that has not bankrupted, it could zigzag for a while. And the last category is if you got a big name and it made money, it does not necessarily mean that you have made more money than the index. So keep these factors in mind. The third and last account, sometimes I call this account the primary account. Primary does not mean it's the biggest, but it's usually the account that consumes most of your time. It causes you the most stress. And in the beginning, usually, the first 3 to 5 years, assuming you want to become an official trader, it usually does not make you money, but it teaches you the most. This is the account where you trade whatever you think you want to trade in. Usually it's items you trade long or short. It's something you don't have to know. It's an account that the expectations that you learn how to trade and can make money in any market conditions. Obviously, very, very few succeed in trading. The very first account we mentioned, which is the long term, typically that's titled as an investing account. This one is usually titled as the trading account. A trader is different from an investor. A trader bets on just about anything that he thinks he knows or knows the direction. He's indifferent about what it is he's buying and selling. His goal is simply to make money, and it's usually long or short. If you're going strictly long on whatever it is you're trading, you're not trading. You're just bullish. You think you're picking names. You're basically just riding a wave. That might work for so long. But a true trader does not care about direction. He is indifferent. He goes long, he goes short. This account is supposed to be, and the keyword supposed to be, the most promising in the long run. Typically, this account, though, you do learn no matter what. If you stick around for a few years, eventually you will learn, and you'll also start realizing the very first things that I mentioned about the long-term account, and you start valuing this your time. This account in the beginning should be for the exclusive goal of learning. Whether you make or lose money, it should not be the judge of success. This is precisely one of the biggest reasons why a lot of people fail in trading is they attribute trading, especially in the early days, early years in this case, a year or two, if not more, they attribute that if they're not making money, they're not succeeding. That is not the case. Trading, learning how to trade, be able to trade in any market conditions and relatively come out ahead in the long run is something that takes years and years and years. And unfortunately, there's no set curriculum for it. I mean, if you can get a bachelor degree and it takes 4 years with a preset curriculum, what makes you think you can learn something that makes you more money than doctors and makes you more money than lawyers and more money than almost any other profession out there, assuming you get the hang of it, assuming you can make trading for a living or master trading? What makes you think you can learn this thing in less than 4 years? The chances are none. And usually you don't learn it in less than 4 years. Is it doable to learn in less than 4 years? Yes, if you have a mentor or you have a guide or you have a very set curriculum that you start off, but eventually you still have to form your own personality, your own style of trading, and your own methodology as well as strategy of how to apply it. Just because you see somebody who knows how to do trading, that does not mean you're comfortable doing the same thing. Think of it like people in sales. You have some people who sell cars. They only need to sell 3 to 5 cars a month to make a living. And think of people who sell phones or insurance. They need to sell hundreds of policies or phones to make the same amount of living. Obviously, the guy who's doing a sale of a car is a lot more stressed and compared to the guy who's selling phones, because each transaction for the guy who sells car represents a larger percentage of his income. So the very first account, if you have not traded before, just ask yourself, do I go short? If you don't, then you're really not trading. Do you go short? It could be in many ways. You could short the stock, you can sell a call, you can buy a put. There's a million ways, and you can do your homework on how to do that. But the idea is, do you bet on stocks or commodities or forex or whatever you're trading going down? Are you indifferent about direction? If the answers are yes, then you're already one step into trading in the sense of you could potentially make money in any market condition. This account, again, in the beginning should teach you. In the long run, you should be able to, assuming you learned, outdo the index and generate higher percentage returns than the index. But also, a second figure here kicks in is how much risk are you taking? If you are simply buying a penny stock or buying a small cap stock that moves significantly a lot, and you made more percentage than, let's say, the index, then really you took more risk. Because remember, those guys who buy the index, they have the advantage of being able to hold it in the long run and recover. Where you in small stocks, or even any stocks at this point, medium or large cap, as we mentioned, that's not necessarily the case. The third factor, which also relates to the second one, is how much risk are you taking in terms of capital? You're making more money with, let's say, $10,000, and you take a $10,000 account and you double it. You're not necessarily better off than the guy who only started with $2,000 and made it to 6,000, because he only made $4,000, but he made 300% of his account. You only made 200%. These numbers are obviously used as an example. This account, though, should be the one you learn from. Eventually, you want to make more money than the returns you're making on the index. You should not stop contributing to an index or doing the buy and hold until you know for a fact you have mastered and have spent, I would say, a minimum of 3 to 5 years trading, that you have a good grip and understanding of it all. At least understanding doesn't mean you'll usually define one style and strategy that you stick with, but you usually be understanding and aware of the other concepts. For example, I know some people who have been trading options for years and years, but yet they have not gone beyond the understanding of what is simply a call and a put. They understand that, but you tell them, hey, do you know vertical? Do you know an iron condor or a butterfly? They usually don't. Do you know about commodities on Forex? They usually have no idea. And it's not here that you got to know it all, but you should have a basic idea, because all these things are related in one way or another. This account, again, should always be the smallest of the three. It will typically consume more of your time, which is normal. But the idea is that you're going to learn and eventually be able to outdo the index. A true trader at the end of the day is a one who can trade any name and who can trade on any market conditions or any road, sort of to speak, any price level. Price level should not matter necessarily, because if you know how to trade, then your goal is not to buy low necessarily and sell high. Your goal is to buy when the price is going to make an up move, whether that was $10 stock or $50 stock. You're not too much concerned about that. You're more concerned that when you're buying, it's going up. And if you're selling or betting it's going down, then it should be going down. There should be no indifference whether you wished you were there when the prices were so low or so high and you got in at the bottom or at the top. That is really not relevant. As you learn more and more, your skill set will adjust. Think of it a trader license. Think of it like a driver license. If you have a driver license, for the most part, you can drive just about any car and you can drive it on just about any road. The basics are the same. You know how to drive, so you can get into any car. You can get in Toyota, Honda, BMW, Mercedes and drive, and you can pretty much drive on just about any road. It's the same thing when you have what's called a trader license. This is a nickname. There's no such thing. But when you have that level of confidence, you're at least not concerned again about too many irrelevant factors. You can get into, if you use technical analysis, and trade just about anything because you're using chart, you're using patterns. You're not too concerned. Did you get in at the bottom? Did you get in at the top? Sure, you might have made more money, but it doesn't stop you from buying when the prices have increased if you think the prices are still going higher, or selling after a big drop if you think the prices are going to go lower. Selling here being short selling. And the same concept goes with what are you trading. With technical analysis, you can trade any instrument, whether it be commodities, forex, or stocks. I am a proponent of options on stocks or options in general. That's why I stick with options primarily, and I stick with stocks because of other reasons we mentioned in other videos. So think of it again like this. You can drive any car on any road. You can trade anything on any price. When you feel you can do that and you truly have done it, or at least are not afraid of doing so, and over the time your results have proved to be more superior, which takes years and years, then you can say that you are successfully trading. And of course, one of the biggest things you can also get to is trading for a living. When you pay your bills off of trading, that is also a big checkpoint that you have reached in the progression of how much of a trader you have reached and how good of a trader. Of course, the ultimate result driven factor and determinant of success in trading is the return on investment. That is the worldwide standard of gauging who is the more successful trader. And the second factor that comes, if ever used, which is used typically in the higher and bigger funds, is the risk to return ratio. How much risk have you taken to achieve those returns? So again, 3 accounts. Long-term account trades strictly the index. Medium-term account trades individual stocks if you really feel you must do. I usually don't recommend this. I would say just stick with the index unless you're dealing with super large amounts of money in comparison to your lifestyle, and the time you're putting in this second medium-term account is giving you enough returns in comparison to how much returns you would be making the index, which is not requiring much time. And third is your primary account. This is your third and last account. Again, it's called primary because it typically takes most of your time and teaches you the most. Remember, in this account, success is not judged in the early days by simply how much money you're making. It's more judged by how much disciplined you are, how patient, are you following your rules? Do you have an easy to understand strategy? Do you have an easy to understand style of trading? Does it match with your personality? Does it not stress you? And eventually, at a certain point, when you feel like you've learned, it's also going to be worth your time in comparison to your daily job if you still have one. And let's say are not trading for a living, you've got to gauge that out. Thus, always keep your long-term account, the account that's in the S&P, always keep it on and almost indefinitely, because a lot of professional traders that do trade for a living, they typically also have long-term accounts because there's one thing that is not present in all the other accounts is those accounts usually don't require much time, if any. Sometimes it takes no time at all. You just buy and hold it for the long run.